Press live.
Hi, everyone. Welcome to another market talk. We had awesome 2 weeks, very interesting. Of course, not exactly what a lot of people expected, but it was still interesting, and especially today, markets are ripping, volatility is low, so I'm sure we have a lot to talk about. Rafael is sad because VIX is not at 35 yet, but you know, it's life.
Yes.
Okay, so yeah, I'm sure we will have a lot to talk about today. So Brian, let's start from you. Hi, what are you trading and what you see in the market?
Sure, yeah. So been getting wrecked as a bear as usual. None of the macro thoughts I had played out. Powell was a big old dub today, so that did nothing to break any kind of thing in the market. And so what I've been watching closely was just looking at the SPY gamma structure, and like for the last week or so, we've had 400 being gamma flip as well as the absolute gamma level. And I'm going to pull up on my screen here to show you all this. Just every single attempt lower, even before today, got bid up. Can you allow me to share a screen, Raf, or buy one of the two?
Yes, sorry, I'm doing that now. Okay, you should be able to.
Let's see here. All right, can y'all see that okay?
Yes.
Yeah. Okay, great. So yeah, so every single attempt below 400 at the time, it was a little stronger earlier in the day, obviously got bid up on all the catalysts last week. It kept getting bid up as well, and markets just couldn't go lower. And so whenever I saw that, I just stopped shorting over the past week, just letting it do its thing and go down. Looked like maybe we'd break. It wouldn't break, and then it would stop going down. And so I've been pretty much on pause for the last week or so with shorts. On the board, I did try to put on, I do have on the XLU IWM spread, which has been getting wrecked. However, I look at the long-term upside downside in that one. I thought the best way to maybe approach the market going higher or lower over this recent kind of uncertain period was putting that kind of neutral spread on the board, but certainly hasn't done well and really hasn't been that a great way to express it. And so any shorts I do have equity-wise at this point, I need to have catalysts from an earnings perspective, because everything's bullish trend. Nothing's really breaking down. And so if I'm going to take any shorts at this point, since the market isn't breaking down that are bullish trend, I need something that's going to snap them. So there's like some retail earnings, VSTO reports right now. I haven't seen what they put out yet. Got Canada Goose tomorrow. Google's reporting. So some names like that I'm looking to take short, just trying to make something off of the print. But otherwise, I don't have much confidence in equity shorts here that I can really hold on an overnight basis and run with. Bond shorts didn't work today. Gold short didn't work today. Nothing worked today. It looked pretty good earlier in the week. Bonds were working on the short side. Gold were working on the short side, and into FOMC today, it certainly didn't. But partially, in some ways that is a good sign. So looking at correlations here, which is what I have up on the screen, we did see correlations strengthen onto the down move of the attempt on the open. They started strengthening 2 days ago, strengthened yesterday, and then now in this big squeeze on the open day, re-strengthened today. And so that does increase potential risk here. So the fact that it's so correlated to the up move with bond yields down, dollar down, they can get a little more extreme. But if we get some kind of dollar bounce off of, I don't really know what catalyst is going to do it at this point. And we still got more to go through this week with ISM, NFP, and the ECB. Really no idea if that's going to be able to do it. But there is risk here for the market to potentially reject what happened today. If I go back to this, they chased 410 really hard, and they didn't actually really commit above. And if we look into the close, the market actually came down a little bit off of there. So 410 on SPY is the call wall. If we fail on that tomorrow with this level of correlation risk, I'll actually consider looking at some shorts, and there's potential that we could fail back. If we look at IWM, this has been just the absolute performer, is the one I'm actually most interested in on the short side, partially because what I'm doing the XLU IWM spread. And then also if you look at implied vol on something like IWM right now, Implied vol and IWM got smacked back down right into the close, into the lowest print we've seen over the past year. So puts are very cheap. That's getting people to maybe bounce VIX off of your trend graph, which I'm sure you're going to talk about there. So puts are very cheap on those. And we're smacking up against the IWM call wall right into the close. And then on Q, and then so we need to fail at 195, which is a call wall. And then 190 here is a big absolute gamma strike. So if we fail at both of those, the market could break down. Not happening yet. Maybe earnings will start making it happen. I don't know what's going to make it happen at this point. Pretty lost from a macro perspective, but that's potential there. And then QQQ 300 is really big. So I need to see QQQ fail at 300, SPY fail at 410, and IWM fail at 195, and then 190, and then SPY 400 is the real big one that would really catalyze some downside if we got it. So yeah, otherwise, I'm definitely not going to go long here just because I still think we're in a bear market, and I just don't really see I don't see a means by which I can get long safely here. Anything, stocks, bonds, gold, they're all correlated. So it's like if the dollar just bottomed today, I know it went up against your 110 euro USD buy. So if the dollar just bottomed today, then it could bounce from here, and it's going to wreck everything if these correlations stay. So yeah, I'm not calling for some big reversal tomorrow or anytime soon. Been pretty wrong from anything from a macro perspective causing that to happen. But the recipe is there for some kind of risk to rebuild in the market. And today was actually another step in the direction towards that occurring. And so 410 is upside resistance here. If we get above 410 tomorrow, it's probably going to keep going higher, and I won't short. And I'll just keep playing it like that and trying to put a short on the board. If it doesn't work, I get stopped and move on and just try to limit losses along the way, which has been kind of hard to do because this market just rips all over the place. But yeah, that's where I'm at. And so we're just going to see what happens. I don't really know from macro perspective at this point. But if there is some kind of macro thing that can start moving this market, now is the time that it could turn after a day like today. So that's where I'm at.
Yeah, interesting. It's very hard to see, to know, of course, what will happen in the short term. Okay, Ted, let's continue with you. What changed since our last talk, and what you see in the markets?
Yeah, more confirmation since our last talk, I think. So let me share my screen as well. Give me a moment. Try to help Brian. Let's see. Oops, sorry. Don't want to share it. Want to slideshow it. Sorry. Okay. So as I explained last time, I try to, invest with the current macro framework, just trying to understand where we are in this growth and inflation regime, what's going on from a policy response point of view, and how do the liquidity dynamics sort of weigh into this overall process, and how does that drive flows, and how does that improve market position, et cetera. So I also wanted to touch on, I think one of the things we wanted to chat about, this term Goldilocks has just come out of the blue in the last 30 days, 40 days. It's been coupled with, this quote, immaculate disinflation, which literally I just started hearing about like a week and a half ago. So these are some things that are sort of circulating around the tradosphere that I thought I'd touch on and try to draw some conclusions about where we are in this macro environment. And then I'll touch on at the end just a couple of trade ideas. I trade kind of longer time frames, and I've been using an indicator that I found to be pretty good recently that I'll just touch on. So from a macro point of view, basically we've had 2 quarters of back-to-back GDP increases in the U.S. 3.2%. You heard Powell today talk about, basically inflation. Growth at 1% for the year. But we had two down quarters of GDP with relatively or very high nominal GDP. So our inflation rate's been high. It's come down, and as that's come down, and as growth continues on a nominal basis, we're getting some positive GDP. And I think that's really important for the regime that we're in. Because, and I'll get to that in a minute, but because wages have been high and rising. I know in our business, we increased workers' compensation by 8.2% in October. and now we're running at an inflation rate over the past 3 months. It's at less than 3%. So we have a situation where, people have real money in their pocket. They're making gains versus inflation. So basically, we've got a positive growth regime. I think it can stay that way so long as inflation continues to come down. I don't think we're making much of an improvement in terms of nominal GDP, but real GDP continues to rise as as inflation comes down. On the inflation front, yesterday we got a big report, and I was kind of surprised to listen to Powell dismiss it a bit today. But as wages still being high, but we've seen, this is the employment cost index. The employment cost index comes out quarterly. It's total wages plus benefits paid. And we see that came down to 1% for the quarter. So basically running at a 4% annualized rate, way down from where it was. Why is that important? This was from the presser from December. Powell was really focused on 55% of PCE core inflation index. It's basically labor, and he's been really focused on labor. And he's pointed out that the imbalance in the labor market between supply and demand is something that they need to deal with. And we've got a 3.5% unemployment rate. Some are arguing that it's not really 3.5%, but that's what the data is telling us. We'll find out more on Friday, obviously. But clearly, there remains a imbalance between supply and demand, and that's what the Fed's been focused on. So that's what I've been focused on. So I basically commented on Sunday. I was doing my market review, and here we go into FOMC. We had really extended Goldilocks and a fourth quarter ECI report due on Tuesday. I was expecting a hawkish 25. We got it. A hawkish 25 is not a 50. It's dovish, and I think we got exactly what we thought. I was expecting a pullback in risk assets to start the week and a bounce in the dollar. And we got both of those on Monday, and then we got a rip yesterday. Then we pulled back again today, and then we had Powell, and off we went to the races. So, interesting market environment. From a liquidity point of view, we have a balance sheet that just continues to drain. The Fed balance sheet just continues to drain. We've seen $496 billion come out of the Federal Reserve's balance sheet. That's 5.5% since the peak in April of last year. So that's just kind of going in the background, 90 billion a month, just grinding down. And then recently, this past week, which I thought was pretty interesting, and I thought might drive a little bit of a pullback this week, was the Treasury general account has increased last week by 45%, or 152 billion. That's negative as far as liquidity dynamics. It supports what Powell's trying to do, which is basically, constrain the economy and the growth and bring down inflation. So I expected that we would see some level of pullback this week to start. As far as the liquidity is concerned, a lot of that is Janet Yellen getting ready to battle with Congress. So she's been issuing a lot of T-bills, and I've been happily buying them at 4.7% on a 3-month. So she's pulling money out of reverse repo, which is my next slide. And we saw that reverse repo into the end of the year really kind of rise significantly. Reverse repo is simply money market excess bank reserves. So as those funds have come out of the money market funds and into Treasury bills and also into the market, that's fueled the rallies that we've seen recently across assets. So the question to me is, where the hell are we? Are we in Goldilocks or are we in deflation? And back in November, I put out this is just a tracker I use, and I update it weekly, and it's a basic recession cometh portfolio. And it's basically short the indices, it's short commodities, it's long the US dollar, it's long TLT, IEF, and bills. And I put that on 11/21. I've been tracking it ever since. And it's positive. It's got a positive return, but it peaked out around close to 2% in December, and it has come down ever since. And a couple of weeks ago, I put out a Goldilocks sort of tracker, which has long high beta, it's long value momentum, it's long mid caps, EEM, EFA. It's also long commodities. It's long yen and in particular long the Aussie, also long bonds in terms of LQD, HYG, and CWB. These portfolios should kind of work as an inverse to one another. In the last 2 weeks through yesterday, it was up 87 basis points. So where does that leave us? I was just looking at the monthly data last night, pulled these charts. First chart over here is high beta SPHB. For the month, it was plus 16%. I mean, just a face ripping rally, and looking really bullish to me. And then SPLV, which is low beta, was off 15 basis points. I mean, that's your defensive areas. XLY, consumer discretionary, up 15%. XRT, which is retail, was also up a considerable amount. And your defensive XLU starting to roll over, just not performing well. So what I'm seeing is basically we've got, growth is up or at least flat, inflation's down, and that means more money in consumers' pockets. And talk about XLY and XRT. I think GDP is holding at that nominal level. It's above inflation. It's positive. It gives us a real GDP number. That's money in the pocket that can fuel this expansion for a little while longer. And then I think, myself included, I'm not a big fund, but big funds are underinvested, and it takes time for them to turn the ship. And the question to me is, do they have FOMO? Do they really want to get involved in this market at this point in time? They have career risk just around not keeping up with the market at this point in time. And I was looking at Mark Minervini's post today, and he was basically saying, hey, I'm still mostly in cash. I'm playing this light. I think a lot of people are in that same boat. I've got 60% in bills in my trading account right now. So basically sitting on a fair amount of cash and playing China, playing commodities in terms of silver and gold, and GDX are some of my better positions. Here's the thing though. We've got a generally positive liquidity environment, but we've got this, and this is what turned me super negative in the fall, and that's the 10-year, 3-month yield curve inversion. That actually went to, I think, 125 basis points negative. It has always preceded a recession. I think it's coming. I mean, and the long and short of it is we're being paid 4.7% to take zero risk. So why? Well, mostly zero risk. Who knows what the Congress is going to do with the budget ceiling? But nevertheless, we're sitting there with 4.7%. I don't have to take a lot of risk. I've got inflation now running 3%. I've got 1.7% real. I mean, hell, we haven't had that in decades. So it's hard to get really super bullish, but nevertheless, I think you've got a bullish bias to the market. A couple of trade ideas. One of the things I focus on is looking at short-term trend, longer-term trend, and I've really been noticing over the past couple of years how I'm seeing the trends, but I'm not getting in front of them. I've been trying to get in front of them, and I stumbled upon this indicator that's worked pretty well for me, which actually got me long TLT in November, and it's got me long a few other things. But what I got this past Friday, a week ago Friday, was a buy signal in Williams percent R, and it's basically an inverse of the fast stochastic. You can see, basically on this DBA, which is agricultural commodity, that the ATR, the average true range, the volatility measure, was basically coming down, and I've been looking for this thing to turn around and go up. And on Friday, I got a signal here. This thing flipped positive. I took the trade into the close on Friday, and over the next 2 days, Tuesday, it was up 1.8% over that 2-day period. So I basically bought here, and I hate to chase, I got to tell you, but this thing was neutral to bearish trend, and all of a sudden we've got a neutral to bullish conversion, and I've got a position. So at least once I have a position on, I can kind of follow it, and I can add to it as it kind of moves about. Silver, I've been looking at. I've held this since I think November. I've got an SLV position, and then I've been watching this Williams percent R. You can see it's like super extended right now. I don't know what it's going to do. Is it going to roll over? and you look on the daily chart, basically it's been building this base. Volatility has been compressing over the past, since really December, we've been trading in this range, 23.5 to 27. So I've been looking at this, watching it. I've actually reduced my position. I mean, some would say this is a bullish flag. I don't know. It looks heavy to me, but we got some positive price action today. So we'll see. This is on a tight leash. And then what I'm seeing this week, I'm seeing XLE with the same indicator has basically rolled over. It failed here. This is looking like it could really go down sharply. And of course, oil's not been performing well. And my UNG call that I took yesterday ain't doing well today. So anyway, so I think XLE is breaking down. And so we have to watch that pretty carefully. So that's enough for me.
Thanks, Ted. Great ideas. And yeah, if XLE goes down a lot, inflation will go down too. So it will be hard for bears. Okay, Christopher. So what's going on? Why markets are going up?
Okay, first of all, hi guys. In my opinion, it's what I see in my data analysis and in my models is that recession probabilities, they are falling pretty hard in Germany, as well as in the US, in the UK, in France, in Spain, in Sweden, not in South Korea. So if you look at daily correlations, you can see that they're minus 1.6 with the recession probability. So you can basically argue that it's due to this most likely to continue rally until we see some data change, in my opinion. But I also had some slides. But I totally agree with that. You got a pretty good opportunity in holding short terms, 3 months. It's really a pretty good recessionary play. So with this kind of level of interest, in my opinion, it's a no-brainer. So it's basically risk-free. With respect to the Goldilocks scenario, which you can see here, I posted this on my Substack, where I elaborated on the quarter-over-quarter growth rates for the GDP. So I usually don't like to use this as an indicator for determining Goldilocks scenario or growth scenarios, because this thing most likely goes up. And if you back test it, you can see it around here. You can see it's basically everything is Goldilocks or reflationary. So in my opinion, this indicator is it's too fast. It tends to move, or basically it's pretty slow. As you can see in 2008 and 2009, you got some head fakes right around here in the black circle, where you could see that maybe it's this head fake signal that growth continues to grow when you look at quarter-over-quarter growth rates. But if you look at the back test, if you use the rate of change and then differentiate for the slope, which you can see in the back, you can see that the economy was already slowing since late or mid 2007. So you did not have this small head fake in the quarter-over-quarter growth rates, which back tests way better, which you can see here on the right side from 2013 to now. It's in my opinion, it's way better to use this as a definition for growth input or Goldilocks scenario. But in some quarters, you can use the quarter-over-quarter. It works better this way. In general, if you look at more than 30 or 40 years, the rate of change, and you look at differential 3-month differentials of the rate of change, it tends to back test a bit better. So I tend to be very cautious with this quarter-over-quarter growth rate, because we got some good government spending in this report. So it kind of helps to to move up the overall GDP numbers. But for the actual slides, I tried to look at the credit ratios, credit to GDP ratios. So, all right, so you can see it. So basically, I like to look at credit as an indicator. You can look at the BIS indicators for private credit, which are pretty good overall. So this is basically a verbal model derived from Hyman Minsky, who studied these kinds of credit booms and busts. So what you can basically hear in this verbal model, you can see that he starts with after recession, so banks and businesses, conservatives with loans and debts. This means companies will only undertake useful projects with a positive net present value. Some projects flourish. This increases economic growth. Private debt grows, probably exceeds GDP growth. This boom drives up cost of materials and wages, which will reduce profits. Investment declines overall, and the economy enters a recession or growth downturn. Wages and price levels fall, corporate profits are restored, but overall debt level is not reduced. And the cycle repeats until the interest burden is way too high. So, and this is what we see historically in the 2008 or in the GFC. So what you basically see here is in the blue line is the rate of change of the overall credit available. You can see it tends to move in cycles. It always slows down in recessionary periods. But you can see in the yellow line that the credit to GDP ratio always or mostly continues to move upwards until this point has reached where the interest burden becomes way too high. This was the case in 2008 and 2009. So you can see that credit growth becomes negative. This drags down GDP due to its influence, and as well the credit to GDP ratio declined. So what happened in the Corona crisis was that you got a massive influx of liquidity as well as debt, which puts us back to the level, or put us back to the level of over 150% or over 160%, and interest the rate of change began to move upwards again. So this data was only available to Q2 of 2022. So I tried to model it to get the actual number. But first off, you can see some relationships of the rate of change in credit. So what you can see here is in blue line is the rate of change of private credit with relationship to the workforce, which is basically unemployment rate divided by civilian labor force. And you can see these counter movements and the good negative correlation when credit falls, workforce, the available workforce rises, or basically overall unemployment rate, which you can see in 2008 and 2009, which is did move from 1% to over 9% in this time period, while credit falls below -2% in year-over-year terms. You can also see the relationship with inflation. So credit leads in some way inflation, or moves at the same time. You can look at the 70s and 80s period, where you can see this sharp rise and sharp falls in the credit in terms in the year-over-year change in credit, as well as the CPI. This is also a pretty good relationship, in my opinion. And with all of that, I tried to look at the overall credit ratio. And you can see on the right side, you can see the actual estimate. So at the current rate, it's with 3 different models. We're currently at right around 9 to 10%, which puts us back to the same level of credit growth in 2006 and 2007 at this point. So what you basically can say is that the latest GDP growth number was heavily influenced by further credit creation, which is afterwards not a big surprise, in my opinion, because we saw some GDP growth. And with that, you can also see why the stock market would had this recent price behavior. But overall, this is a level where we should be very cautious, because this credit growth exceeds, as I already mentioned, exceeds the GDP growth to a pretty high factor, which happened in 2000 and in 2006 and 7, which predates each of these recessions. So if credit creation continues to continues to stagnate in the recent quarters, this will most likely drag down GDP to a lower level, to a way lower level, in my opinion. If it falls below below zero in rate of change terms, then we got a pretty big problem in the USA. But this is not the case for now. So another thing is that we got the ISM new orders number, which is now at 42.5, which is a pretty good indicator for a recession historically. You can look at the horizontal line in the blue one. You can see in yellow the ISM new orders line time series, and in the blue one the ISM number is a pretty good correlation, which has a 1 to 3 months lead. And you can see this the gray shadow bars is a recession line. So this was always a pretty good signal, but you never know what will happen. So this is another signal for me to tend to be cautious and play risk off, to hold lots of cash and to go into bonds, as Ted already mentioned. Another one is that I look at the ISM forecast, which are 8 time series which lead ISM historically, and you can see that we're most likely will bottom in May 2023 at around, with these two models on the left side, you can see at around 44 to 43, or we could land at 46. This depends on the future data development. And on the right side, you can see the Bayesian bounds on this regression analysis. So if we enter a recession, and the data points would suggest that we're at a recessionary level, then it's likely that that the ISM moves to the lower bound, which is currently at 40. So this is a possibility that tends to be open for the next month. And if we use this as an indicator for the S&P, then this puts us on the left side at right around this red circle. So this is at, I would say, at -15 to -18 in year-over-year terms for the S&P. So there's not much room left, which is not good if you want to short it, in my opinion. So you risk off play long dollar, holding short-term bonds, as well as having a big cash cash position. If you're in the European Union, this might be the safest play, in my opinion. So that was all for me.
Thanks, Christopher. So, Rafael, VIX is not at 35. So what are you doing about it?
It's 34.
Oh, 34. Sorry.
Yeah. So yeah, I was looking for rip in VIX, and that didn't happen. So we're gonna have a look at why I was expecting that and what I'm looking for now. Screen share. Okay, should be good. Okay, so basically the setup I was looking for was the one I've explained in the previous videos. Was when the trade of Vola VIX was rejoining the trade of the trend of Vola VIX was the start of the rise for VIX, and so this time we are getting a lot of resistance on volatility to climb. I'm not an expert on the why. It's just it's very hard for volatility to rise. I would have expected the VIX to be in at least in the 23, 25 area, at least on this retest, and it didn't happen. So when I saw it didn't happen, I deleveraged my portfolio, especially considering I was long vol and heavily short. So I deleveraged on the 25 and decided to wait. What I was waiting was actually what we saw today. The idea was to wait for Vola VIX to retest trade of Vola VIX. So a pattern that you can see before. Here, retest of trend. So that's basically what I'm looking at. If we don't see a reaction of VIX here, it means definitely the risk on is on. I mean, I don't see how we would get volatility of VIX to rise, and actually VIX aiming for maybe below 17, even 16, and don't see a risk on environment. So I started to come back today. I'm waiting to see if it's going to pay off or not. So regarding indexes, they are as bullish as they can be. I mean, I will show you then on my fractal range, but you can see volatility of SPX is just going down. It retested a trade here and held, and it's doing basically what the European markets have done since October. You have volatility crashing, and of course, asset price is rising. You can see the same pattern in NDQ. Volatility is crashing, starting to get some overbought signal on daily. It's usually a sign of top, but who knows? I think the Russell is doing the same. Yeah, Russell, same pattern. You can see volatility is crashing. So yeah, not very easy for bears right now, because volatility is crashing, and you can see on my fractal range also that everything is bullish. Basically, you have S&P bullish, Nasdaq bullish, Russell bullish. It's been for some, it's been weeks they are bullish. So we are fighting against trend. Sure, the upside downside ratio today is starting to look appealing. You have the CAC, for instance, with the upside downside ratio, long-term upside downside ratio actually getting very tasty. Same for DAX today with S&P, NDX also, Russell also. You also had the VIX with upside downside ratio above 1. But you have to consider you are still fighting trend, right? Something happened today also regarding UUP. First time we got the upside downside ratio to go above 1. So that's not surprising considering the crash that we had. It's the first time I see that in months. I mean, I've never seen upside downside ratio in UUP to go above 1. So could be a sign. We're gonna see. Something happened also on my volatility signal. So we had volatility of DXY, which was basically flat since November, doing nothing, and it's starting to go down. So what we want to see now is basically we want to see DXY actually reclaim trend. For now, it's trying to reclaim trade. We want it to reclaim trend to start to get an up move. For now, I consider we are still far away from it. So we have some clues with the upside downside ratio on UUP. It will be interesting to see tomorrow what's the upside downside ratio on DXY. we have here the trade being reclaimed, but we are still missing trend. Euro USD, so same principle as for gold, silver, etc. that I explained for several weeks. So I have a minimum that an asset can go to based on previous volatility profile for its volatility trade. Euro USD is very near from it, and my expectation is to see the vola of Euro USD to start going higher and to see Euro USD crash. Okay, so the upside downside ratio actually today was interesting. You have a limited upside, especially considering the bounce that we had, and the long-term upside downside ratio is also getting interesting. You can see that here. Then last time we took a bet on US oil. Actually, US oil went bullish for a day, I think. It was that day, 23rd of Jan. Actually, MFR also triggered bullish trend inside the day, but then we reversed back to neutral, and I think we went back to bearish. Yeah, so it went neutral, stayed there for a long time. One change intraday went to bullish, but didn't hold. So even though volatility of US oil is starting to go down, so of course I'm monitoring that. That would be a surprise. Same principle as your USD, minimum of vola trade for gold. So vola trade is below now. So my expectation would be any day volatility to try to go up. It tried for several days, and today again with dollar crashing, of course, gold is going up. Platinum is a different story. It started to go. So that was the chart from last week. So what you had is volatility start to rise, held vola trade, and now it's going higher. So the question is now, will it hold a trend or will it go lower? I started a position in platinum at the retest of trend. Now the question is, does it go higher like it did before? And then it's just we have to wait for an extreme volatility print to get back in, or will it hold? That's the question. Silver vola is trying to rise as well, but for now it's holding. I didn't mark the minimum this one, but it's starting to get a little bit shaky. So same expectation, could go up. Bitcoin is almost there. This is the minimum for vola trade, so I'm waiting for this to trigger. I went too early, short Baito somewhere here, maybe before, but yeah, it was too early. So now I'm basically waiting for Bitcoin to trigger this. Yeah, I mean that's what I'm looking at. I'm trying to think if I missed something, but yeah, it's if you look at MFR, everything is bullish. I mean, it's crazy. It's just bullish, and but yeah, some interesting signals. So of course, the upside is starting to be limited. VIX is has a decent upside potential. Euro is starting to look interesting on the short side, and UP potentially starting to go for the long. But yeah, I'm trying to be very patient. So that's why I deleveraged on the 25th. That's why I waited for today to come back. But yeah, this Goldilocks talk that we hear, and we saw also a lot of artificial trend break. So I guess this will make a lot of people salivate and trying to go long on this kind of technical breakup. So I'm trying to wait. I can see correlation also are getting interesting. I guess Vi, you will talk about that, but you have TLT UUP deeply negative. You have correlation that are starting to strengthen, and yeah, this is some interesting signals, but yeah, I'm still on the sideline waiting, and yeah, hoping to get back in. That's it.
Yeah, and the short-term stock bond correlations are also supporting our views, but of course everything else is not supporting our views still, so time to wait. Brian, I know that you need to go, but if you have a couple of minutes, we have a question in a chat, and I think that maybe you will have more to add than me, or for example. So Beck is asking, it seems that 0 day to expiration call options are pushing the market upward on a near daily basis. What is the catalyst for this to end? And do you think institutions will buy 0 DTE puts on the way down?
I have no idea if it's going to end or what would cause it to end, or all I know is it's pretty mainstream right now. So I think I mean, in my opinion, just a feeling, I think it blows it all up one way or another eventually. But basically what happens, like, I see it today, you see it today too. They'll run up into wherever you get to. So today they chased 410 into the call, into the close. And so that strike grows really aggressively and becomes a new call wall. And then you get there. And then the next day, you reject off that strike. This happened yesterday too, when they chased it into, I forget where they chased it yesterday, but that strike became the call wall. You reject off, they clear the calls in the morning, and then it opens up either the upside to wherever you can go higher the next day. And so I expect the same thing probably to happen tomorrow. They chased 410 today, whether it was 0 DTE or not 0 DTE. I don't have a filter to see which is which, but I know in the morning they'll probably reject 410, clear the calls, and then the question is, then do they push it up higher, or then do they come back down? I actually, in the funny thing about the 0 DTE stuff, it does seem like it's just the 0 DTE calls. Like this is only a problem recently when they chase the upside with the calls. And so I don't know if they're ever going to come in and do it to the downside. That would help. But it seems like all they really do is sell puts out of thin air and crush vol and then buy calls to the upside. So, yeah.
Yeah, totally.
In part,
okay,
isn't that because some of these institutions are significantly offsides, they're underinvested, they're just trying to capture some of the upside as it sort of materializes here while they start to reposition their portfolios and get more long. So, I mean, there's a big institutional play here from what I understand, as well as, obviously day traders and the like, but it seems like once everybody's all aboard this thing, then we may see that flip and maybe a dissipation of the call side and to Brian's point, maybe even to the put side.
Yeah, I mean, what this has caused is because a lot of the vol that they're selling is longer dated vol. So if you look at like the VIXM, for example, which is 5-month vol, that thing's gotten absolutely dominated, like completely crushed, way below where it's been any time this year over the past, 2 or 3 months. And which has sucked because it held up broadly with VIX throughout the course of the year. And so you think that recently in this recent bounce, when VIX started drawing down, when we got to 30s in October, that VIXM would just stop when VIX stopped going down. That didn't happen at all. They started just crushing the longer dated vol. And so longer vol is really cheap right now if you look at it through that lens. And so if you are to go into options, which with the VIX of 17 and you have a bearish bias, it's a pretty good bet in my opinion right now. I look at like March 31st, for example, as a potential strike to go as far as that. If anyone wants to bid that up for me.
Yeah. Okay, so I will share my screen right now. And not this one. Yeah. What I'm looking at, and today I did something. It was I bought just a little bit of USD just before the market closed, and the reason.
Are you trying to share something right now? All we see is a blank screen. We see your face now, your YouTube.
I'm trying. And now?
Still see it's like your desktop or wherever you were opening, like the YouTube web app.
Yeah.
So try and drag whatever you're doing over to that screen.
Mm-hmm.
Stop the share screen and press again. They will ask you what screen you want to share, and you select the right one.
Yeah, now should be good, I believe.
Yep, you're good.
Yeah. So the reason was that UUP, even though, yeah, of course, it's in a strong bearish trend, but it printed the upside downside ratio on a shorter term range, which is higher than 1 finally. So I didn't use UUP, but I simply converted some euros into dollars in my trading account, because where I'm at, it's a lot easier way to do. The reason is not only this, but also a couple of weeks ago, we were talking, and based on futures volumes, and yeah, so basically on euro futures, 1.1050 was a very strong level, and today euro dollar touched that 1.10 level, so it was even better. So I thought, okay, maybe I need to add to my forex dollar position. So that's what I did. So this is the shorter term ratio. So for tomorrow, we see that SPY has upside downside only of 0.55. And that XLE, of course, is huge, but I don't think that it will last. But basically, the only signal you can take from this is that if for one reason or another you want to short XLE and you don't have a position yet, maybe currently it's not the best time to do that. You need to wait for more confirmation. But yeah, so good news that finally I did something, because nothing new in my account. I still have SPY put spreads, but they are very close to the level where I will be stopped out, and actually very close. So maybe even if market continues going up, that put spread will be stopped out tomorrow, I believe. From the longer term perspective, also there are a couple of interesting things. So now this chart is sorry, the title is the same, but basically this upside downside ratio is for longer term range. It's real time. I made those charts like 1 minute after the market closed. So you will see that even in a long term, SPY is below 1. So it's kind of a good thing. What has quite a big upside ratio, and maybe Brian, you will like it, is of course XLU. And if you compare it to IWM, so that spread is looking even more attractive. So yeah, I still don't have a position, but yeah, I'm waiting for more confirmations, but it's a good sign. So yeah, so these are upside downside ratios, and actually today yesterday on a shorter term, MFR also printed a positive upside downside ratio for TLT. So it was also a good way to avoid shorting bonds into today. But I wanted to show, because of course I mainly use the signals. I work on MFR, and so basically what's available on an MFR or what we are planning to include. So I will show how I view volatility and why it's very low right now. Of course, we all know that it's very low because of VIX, but basically for those who are monitoring range, on a daily basis in Excel or using other methods, it's very easy to calculate, but basically it's a range div as a percentage. So this one is a regular short-term range, so you can see that relatively it's going a bit up, but it's relatively low. So now it's like 5% range on SPY, and it's relatively low. So what I want to do, what I want to see before starting to short those indexes, so IWM, QQQ, SPY, and so on, I want to see this going up to at least more higher levels. And when more higher levels, at least, let's say, closer to 6-7% or so. But of course, this is not the only signal, so you can combine that with VIX and so on. But for those who are monitoring the changes, I think that this is an interesting way for you to monitor assets. So formula is very easy. Basically, you take range high minus range low, then you have a number of points and you divide it by the current market price. So it's very easy. And longer term looks a bit different, but still relatively low. So for example, currently longer term is at about 14%, which is, it may sound like a lot, but it's not. And there is a reason why I use it from 2022 March or April, because in this regime it's relatively low. So you can see that both on lower time frame and longer term ranges, the volatility is relatively low. So that's why I'm still not trading iron condors. I was talking that I will trade iron condors, but no, for that at those VIX levels, it's not even on my radar. I need volatility to go way up. So yeah, so these are upside down ratios, and the main reason why I bought dollar. Nothing new, of course. Longer term bias still is the same, but we need to wait for confirmations. And for example, average correlation to SPY. Also, I made this chart like 1 minute after the close, so it's new data. For example, shorter term correlations went up, but longer term correlations went down, because 30-day sector correlation to SPY is going down, and today it continued to go down. So from correlation risk, it depends on your time horizon and how you trade as a trader. Because if you are looking for more sustained moves for at least weeks or months or so we're still not there based on correlation risks. But short-term signal is totally different. So 5-day correlations spiked up yesterday, and it continued to go up today. So yeah, I expect CHOP to start. Well, I wanted to say I expect CHOP to continue, but we're for the last couple of weeks, it's very hard to call it CHOP because market was ripping. So yeah, but I expect CHOP. So don't get me wrong, even though I expect market to give opportunity for bears to make some money, so red days and maybe even strong red days, but it's still, based on what I see, there is a big risk that, we will have one red day, then we will have another green day. So now market will try to kill everyone, so basically both bulls and bears. But if we look at the longer terms, of course, still I'm sure that this year we will see new low levels in SPY and so on. So I agree with those people who are very bearish about the future, but at least in 2023. But of course, we will see. For now, from signal perspective, I see no reason to open some longer term short positions. But of course, if your horizon is short, we're talking a couple of days or so, then maybe based on upside downside ratios, based on today's price action, and by price action, I mean that basically SPX went like few points away from MFR end of day top of range, and then went down quite sharply. So it can be a good sign, but we need at least one more day to see that. But at least based on upside downside ratio, maybe for a couple of days, if you risk manage it well, maybe it's a good idea to see what markets will do tomorrow, and maybe to open very small short positions. Of course, if you don't have them. Personally, I only have those put spreads. If tomorrow I still have them, because there is a risk that I will be stopped out. But basically, and the momentum scores. So 5 and 30 days. So of course, XLE looks terrible. XLY is very strong on a 5-day basis, and you can see that majority of sectors are in a positive territory. Dollar is of course negative, but it's not very negative. So with this momentum score, I mean, it can switch at any time very quickly. And so on a short term, if we're talking about equities, basically momentum, short-term momentum is positive, and of course longer term momentum, 30 days, not surprising as well. But we have things like XLU, XLV that are slightly negative. Of course, dollar is strongly negative. But you can see I want on basically at least majority of signals to agree. So that's why I'm waiting, and of course it was a good idea because we all see what markets are doing. And Hearst exponents are not really weak, at least if we're talking about major indices and so on. So first we need to, at least I need some confirmations from price action to make some decisions. And of course, for majority of things that I do in this regime, because of course I'm not always, but in this regime, for majority of things that I do, for majority of strategies, I need volatility to go up. So that's it from me for now.
I have a question for Christopher. So you mentioned that the how to say? Yeah, the recession probability were crashing almost everywhere. So it's this is based on the GDP prints that were published recently, or
This is based on the interest rate models. So where I look at the movement of interest rates, like 2-year yields in a differential over 3 months, as well as interest rate spreads. I shared it on my Substack today, something. But I see it, recession probability for now, latest estimate for the USA is 6%. I have a threshold of 20% where it backtests really well. So risk on, risk off. If it moves above the threshold value of 20%, in the last 6,300 days, the combined return was minus 94%, and if it's below 20%, it's plus 321%. So you can see this inverse relationship. If recession probability falls, then most you have like the price return going up, price momentum going up, the indices, and this is basically everywhere except Canada, Sweden. In Europe, it's still all around Europe, it's still at 100%, but in the if you look at each country itself, it's below the threshold value. So
what would trigger the recession probability to rise if it's based on the rates? I mean, what do you need to see?
You need to see the bull steepener. 10 minus 3 months or 10 minus 2 months. Okay. If you see the 2-year yields fall. And I like to look at interbank rates. So I take for Europe, I take the Euribor 12 months minus the 1 week Euribor. And if you go into recession, they sometimes they invert for interbank financing. So it's, you can basically look at like, it's something like TED spread. So you can look at financial tightening in the bank sector if they move around or lend capital. So this also is a good indicator to track it, in my opinion. But no, overall, we need to see the bull steepener, in my opinion. Every other signal, if the inversion tends to go lower, it's just a signal that growth is declining. So this is the based on the model. So based on my model. So growth, falling growth probabilities is globally at 70%, so above 50%. So we tend to see that growth is still stagnating based on interest rates. Yeah, and you can see it also in the GDP values. If you look at rate of change, so Germany is at what was it, minus 0.1, if I remember this correctly. Yeah. So these numbers move lower. Retail sales are falling off a cliff. But government spending tends to keep the number and backlog orders, they tend to keep the GDP numbers pretty elevated.
What I fail to understand is, I mean, you have a negative GDP print for Q4 in Germany, and the market is not caring. You mentioned also the retail sales data that is just atrocious. And,
that's crazy.
I mean, I don't understand. It's I understand inflation is going down, but I mean, the data is just terrible.
The data is horrible. I like to look at Sweden. One of my models printed this week a minus 5% GDP year over year.
Yeah, Julian Bridgen mentioned this also. He said that when he looks at Europe, he looks at Sweden as a leading country. And you publish also this in your substract. It was interesting. So you see this as a leading indicator for Europe, right? That's
yeah, I tend to see this as well. You can look at PMI data for new orders. This tend to lead for Sweden. This tend to lead the Eurozone by 3 months, roughly. So, and this one is, I think, at, let's look it up real quick. I think it's, where did I post it? I think it's also at 42, if I remember this correctly. So new orders are collapsing. So I cannot make sense of price action currently. It's the rationality in the market or market behavior, in my opinion. But this also tends to open up opportunities for the long run. So
it's the macro thing is a little bit confusing to me. I mean, the signal on MFR is pretty clear. I mean, it's going higher. The trend is higher. But yeah, I hear one guy say deflation, another one say inflation, another one say Goldilocks, and it's like it's a mess. It's been since October. Nobody can agree. The data is atrocious. The problem is like you've got the whole rainbow of interpretation of the data, and the market has been obviously trading like Goldilocks. So yeah, but
yeah, I tend to like to look at price momentum over macro. So if you price action and you'd like to trade it for the short term, like 1 to 2 months, tends to backtest way better than if you still only focus on macro. So it's like yin and yang, in my opinion. You need to look at both.
Okay, good to know. Yeah, that was my question.
So any new bets?
Yeah, it's beginning to be like contra, you know. I mean, so
that's the goal. That's the goal. Contra is always the goal.
Okay, so let's go with big contra. Like, will the market be up 30%? So maybe it can be down 30, you know.
No, if the market is up by 30% in 2 weeks, so when we do our next call.
Oh man,
yeah.
I mean, Yeah, we can do the dollar, we can do oil again. I mean, we can do any indexes. What do you prefer? We can do level on indexes. We can do trend on the oil. We can do trend of or level on DXY. Euro USD.
Yeah, I want to be in trouble. Yeah, so let's test my level. So will Euro USD be higher or lower on our in 2 weeks, or will Euro USD go up above 111 at least for a day?
I'll take that bet.
Okay, so higher than
I think it goes higher. I think your friend Lagarde's going to come out hawkish tomorrow. I think that's going to drive the euro some more.
yeah.
You got what, almost a 110 today, right? So on the
Yeah.
euro.
We got it.
You know, it's just that's kind of a big tell. I mean, I don't know.
So,
Maybe it's in the market. Maybe that's it. But I just think it can still go higher. Dollar looks super weak.
But I must be loyal to
terrible.
myself, so I'm forced. I have to say no, so I will say no because I have to say no.
Yeah, Lagarde, contrary to Powell, is actually defending the currency that we are using. I mean, I made the joke 2 weeks ago, like, why are you buying dollar if even J Powell cannot defend its own currency? I mean, it's just terrible. 25 basis
100%.
points.
Yeah.
While Christine is doing 50 plus 50 plus
She's going
God
to do
knows.
50, and on percentage basis, that's huge, right? I mean,
Yeah.
Hmm.
But inflation is not going down, so maybe that's why. I mean, but yeah. Yeah, I'm hesitant. I'm siding
So what are
with
you guys
buy.
taking? I'm say higher. I'll go 111. What do you got?
Yeah, I'm
I
saying.
think so as well. It's going
okay.
higher,
Okay, Chris.
in my opinion. I currently look at inflows, ETF inflows. So in the last month, the second highest inflow was in iShares Core MSCI Emerging Markets. So if I would read this, then USD probably will continue to drop further. So, otherwise, this does not make sense, in my opinion. So for short, euro could continue higher. Yeah.
In 2 weeks, I'm gonna say no with buy. But yeah, it's I mean, it's bullish like crazy. It's just
Yeah, I agree with all the points. I just need to be loyal to myself, so I say no. Yes.
Don't jinx your own trade. Absolutely.
Yeah.
and yeah, so your USD, we only do this one.
Yeah,
Okay.
I think one is enough.
Okay, let's try with oil again. Oil bullish or not?
Not.
Okay.
Chop.
Not yet.
Chop,
Not
chop,
yet.
chop.
If we're talking
72
about
to
2 weeks,
82,
no.
72 to 82. It's not. We got a floor at 72. Biden's a buyer. It's from the SPR at 72. I just don't see us going anywhere with this thing right now.
Okay, so no bullish. Okay, nobody's bullish.
I think
guess.
I was bullish
Not
last
bullish.
time, but
Yeah, we were, and we got it for one day. If we did the show last week, we would have been right. Chris? No?
No.
Okay,
It's-
well, then it was useless. We are all on the no camp.
Staying true to the disinflation regime
Okay.
for the macro
Okay.
data. So
Okay, guys. So let's wrap this up.
Yeah, so thanks everyone for joining. I hope it was useful. And I'm sure upcoming 2 weeks will be interesting as well. So manage your risk well, as always. So thanks, Rafael, Ted, Christopher, and thanks everyone. Bye.
thanks as well.
Thank you,
Bye.
guys.
thank you.
See you soon.
Bye now.